Tip number 2 in 10 tips to protect your business. Tip number 2 is create the business structure that will provide the most benefit to both short-term and long-term business goals while reducing your tax burden. I'm going to discuss with you the two most prominent forms of businesses that most people start, your S Corp and your limited liability company. First, with your limited liability company. This form or this type of entity is best for maximum flexibility in how you manage and run your business. There is no board of directors that's required for this type of business. You can have unlimited owners, which are called members. You're not personally on the hook for any sorts of business liabilities as long as you run it properly. It's taxed typically only one time, and you're free to choose how this business is taxed. For example, if you're a single member LLC, you're typically taxed as a disregarded entity, meaning you're taxed at the personal level. You can also be taxed as a partnership if you have multiple members. Likewise, if you're just a single member LLC or a multiple member LLC, you could be taxed also as a corporation, as an S Corp. Now, with those, you can go back and forth between those types depending on what your business goals are. There are ongoing fees in order to stay compliant. LLCs cannot go public, and it's not typically recognized globally. Now, with your S Corporation, this is better for your smaller corporations. You can only have 100 shareholders maximum versus a C Corp, you can have unlimited. Owners can only get common stock versus in a C Corp, you can get what's called preferred stock as well. With an S Corp, you're also not personally on the hook for any sorts of business liabilities, again, as long as you're running the business properly. With an S Corp, you're taxed only once time, and it's actually at the shareholder level when you do the distributions. Versus a C Corporation, you're taxed at two levels. You're taxed at not only the company level, but you're also taxed at the shareholder level as well. Now, there are also ongoing filings and fees in order to stay compliant. There's less management flexibility because now you're going to have a board of directors that's typically going to govern how the actual business is run. It's pretty strict as far as the meetings, keeping records. It is more formal of a structure. And all shareholders on an S Corp must be U.S. citizens, whereas on a C Corp, you don't have to be. Now, a lot of people will go into a C Corp for purposes if they want to become a public company. That's usually typically a pretty big benefit for a corporation. Now, outside of that, that is pretty much the differentiation between the types of business entities. Next time, I'm going to talk with you about creating formation documents to determine how owners settle their disagreements, how decisions are made, and by whom, and what happens if an owner passes away or dies. It's very important to make sure you have those types of documents in place as well to discuss what happens in a particular scenario. So until next time, topic 2, done.